What's going on, everybody? This is Wade. Just want to make sure, can you guys hear me? You go ahead and type a Y into the chat, please. All right, looks like we're online. So I want to welcome you guys to this week's webinar. And now that we're online, I'm going to go ahead and I'm going to have Shane. He's going to take you into the volatility report. He's going to be leading the webinar this morning, and I'm going to chime in. So if you guys have any questions regarding specific pairs you're looking at or specific setups, then go ahead and type those in. Once we're done with the once Shane's done going over the volatility report, then we will jump into those, and I'll be I'll be chiming in. He's going to lead the webinar, but like I said, I'll be answering your questions along the way here too. So with that being said, Shane, why don't you go ahead and take us into the volatility report?
All right, thank you, Wade. And just so I don't make a fool out of myself, just if someone could type in a Y real quick to confirm that you can hear me all right. Beautiful, 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 beautiful. Okay, so let's go ahead and jump into the volatility report. This week we have got pound dollar, New Zealand dollar, and a combination of both pound New Zealand, which is actually an update from last week. So I think that I'm actually going to kick it off with looking at pound New Zealand because this one's actually already playing out for us. So I'm going to take a look at the daily into the 1 hour, and we'll just kind of look and see some of the entries that could have come up here, or how you would handle this opportunity, and then we'll go and look through some of the lower time frames as well. So on this guy, I think it's important to look at where we came from. So we featured the pound New Zealand dollar on last week's volatility report. Some of the noteworthy things about it were that we came up, we had a little reaction to this little bit older expansion line, and then we started rolling back down, and then we saw that we were coming back to the expansion line, and that's always a great place to be. When you break through a box, you come back to the expansion line, because then you're going to get a somewhat low risk entry into and really solid information as to what the overall direction is going to be. So it ended up being that we were just a little bit late to the party, or a little bit early to the party rather, and it was just kind of kicking back and forth there for a good majority of last week. Which again is not the worst thing. It just is a different spot to be in. So looking through here for an actual entry, I've got the daily and the 1 hour up. This is mostly what was going on. This little range that we had through here is mostly what was happening throughout last week. Again, just kicking back and forth, which is a very, very common behavior for once price hits an expansion line for the first time, you'll get a reaction to it, and it'll either whip back and forth and continue pushing through it, or it will whip back and forth and then rotate off of it. So in this case, we rotated off of it. So once we had that reaction, we started pushing away, come down. We were underneath our expansion here, and we can see this prior expansion line right here on the lower side of this little range that we set. We started reacting to that guy. So once you saw that reaction, that could have been an indication that we were holding above that, and buy orders were being protected at that point. So getting in under expansion on your entry time frame, over expansion on your direction time frame, that's about as straightforward as it gets as to a long market, and then you could have managed your risk if we got significantly below this expansion line. So we can see we've got nothing but wicks just coming through that expansion line, rolled off of it, and here we are, and pushed to one liquidity line. Looks like we went through a breath right there, and then pushed on up to the next one. So something interesting right here, you'll notice that sometimes these expansion lines will push up through them, and then you'll see a little bit of a reaction there as well. So we had that in this case. We pushed up through the expansion line, and then we kind of held above it. So sometimes in certain situations, you might find that if you're not able to get in down here, and this is still kind of a breakout situation that, you know, you can manage your risk off of these expansion lines. There's a really good example of that on New Zealand dollar right now that we'll get into here pretty soon. So let me go ahead and switch this over to a little bit smaller time frame. Oh, what's up?
I was just going to say, just to follow up with what you're saying, you know, this is the pound NZD on that daily chart. That's really in the volatility report. That's really the ideal situation that we're looking for when we put that report together, because like Shane was saying, you're so close to the decision point on that daily time frame, and you know that daily, you know, the price does not like to be at expansion levels. It's like it wants to, it gets magnetized to those levels, and then it wants to react. It wants to go either long or short from those levels. So, you know, that's really the sweet spot, especially when you can spot that on a higher time frame. You know, you can definitely line yourself up to take some decent sized gains off of you know, off those levels, just because you're so tight to the decision point. So anyway, it's definitely an ideal situation. And it's still not done, you know, it's just pulling away on the daily. So you know, should the daily close green, you know, the rest of the week, you know, there's definitely a good possibility we could still be climbing up long on that trade. However, there isn't any great entry opportunity right this second. You'd want to wait for the hour to reset. You want to wait to get a new box on the hour, you know, get some more architecture at the higher price level before you'd actually want to act on that trade. But it is taking off, so it's definitely one to watch. All right, go ahead, Shay. Sorry.
Yeah. Again, just to restate, I can't stress enough how important it is to be getting in close to your decision point. Sometimes, you know, get a screenshot and it's like there will be an entry like right here, and it's like, you know, where did I go wrong? It's like, well, it just already pushed quite a bit. So that's you know, getting close to these expansion lines, because that's the decision point. Wade made a really good or had a really good analogy last week. You know, we don't really have like an IPO price in Forex. It just kind of is what it is. It, you know, ebbs and flows up and down. When we go through a box, especially on a higher time frame, like a daily or weekly, and then we break out of it, that expansion line is our IPO price, you know, where you can get into a fresh market and kind of go from there. That's our center of gravity, how we know if we're up high or up or down low. So, you know, being into something that's just starting to take off, just starting to get volume in, that's how you're going to find your way into some of these bigger trades, instead of, you know, getting in at the tail end of a big push. So anyways, yeah, I think that's my only point about that. Let me move ahead to a little bit smaller time frame, and then we can kind of take a look at that. So I'm going to move over to the 4-hour and the 15. Okay, let me line up time real quick, 1 second. Okay, so all of this range right here is basically where we were kicking back and forth on the daily expansion line, and then broke away right here, and then came back and tested this expansion line. So we can see a very similar behavior to kind of our daily time frame, where we pulled away and then bounced off of this and started going up long. This is why, or, you know, just to get a little sidetrack, when people ask, you know, what's the best time frame, you know, how do I, you know, what time frame should I watch for some of this stuff? All of the time frames do the exact same things over and over and over and over. So it doesn't really, you know, if you learn something on a 1 minute into an hour, you can apply those same exact things to a you know, a 1 hour into a daily. The actual way that it ends up looking and the reactions to a lot of the expansion lines, they're all the same. I mean, your money management would change a little bit, but as far as, you know, how you enter into the trade and how you look for your direction, that's all exactly the same, regardless of the time frame that you're on. So as far as this one goes, we kicked away from it. That would have been right in here. So the only entries that I'm really seeing once we got away from that average price or away from that expansion line would have been through here. This could have been an entry right in here, push down through through this box, and then would have been looking for profit. Back up into this, buy once it turns green and stays green. Came through here. So we had a few of these situations where we came down below expansion and then could have bought into it. When you have something like this where you push up through an expansion line, starts pushing, doesn't take out the high, when you're this much into profit, if you were able to get in here or maybe somewhere around this expansion line, and it pushes up 40, about 40 pips and then comes down, there's not a great reason to take a negative on something like this. You probably want to drag your stop up just to manage it off of that expansion line again. And then came back down. And once we started getting red candles on the 4 hour, then you want to kind of reevaluate. And yeah, seeing these bounces off of expansion lines, it's just such a telling clue as to what the direction is going to be. Or it makes for a really great time to test an entry. And then you have a very solid point to manage your risk off of. It bounces away. If in the case that it does come back down and pushes through that, then you have a solid information-rich place to put your stop. So if it goes through that, then your premise that buy orders were being protected and they want to take the market long, that premise, that trading theory that you're basing your entry off of is no longer relevant. I'm getting a note here in the chat that someone's not able to hear me. I just want to confirm real quick. Can everyone hear me all right? Okay. Okay, it looks like we're good. So before I move on too much, or move on any further, I just want to, stop and check. Does anybody have any questions about any of this stuff through here? Do you have any questions about how we picked the pair for the volatility report? Do you have any questions about, maybe some of the entries that happened in here? Just if I could speak more on that, just to keep it real simple, if you are above the most recent expansion on your direction time frame, you're looking for long trades. And then in that same scenario, if you're looking for long trades, you want to be below expansion on your entry time frame. Here's a question, or here's one. Would you enter now? Not right now. We are way above expansion on our entry time frame. The last entry that we had through here was actually this guy, because we have not been below expansion one time since then. So it would have been this, which happens to be the bottom. This just goes for the 15-minute chart. We can take a look and maybe there's something on the 5 into maybe the hour. So it was pretty much only this. Again, if your direction time frame is long, then you want to be underneath expansion on your entry time frame.
I think
Here's one from Oliver. If you're already above expansion on the entry time frame but not far away from it, could you still enter? It's not ideal. Sometimes you're going to have a breakout situation, similar to this, but you have to make that call in the moment, but I would recommend not doing that.
Shane, to pick up on that comment, you can, in some of these momentum moves that just really take off, you can enter above expansion, but you got to realize that if you're going to do that, you want to be as tight to that expansion level as possible. And guys, there's no, ideally you want to be below expansion in a uptrending market on your higher time frame, but understand what the expansion lines are. Those are the decision point. So if it goes below that, you have to start asking different questions about what the future of that opportunity is. So that's why you want to manage your trade in and around that. So if you're going to buy a breakout on a box, understand if that breakout fails and it doesn't go, then it's going to come back to that expansion level. And if it rejects the expansion level and keeps going in trend, well, then that's great. I mean, that's, you know, in the direction of your original trading idea. But if it gets through there, you know, you got to ask yourself what's going on here. And so you got to be, if you basically, if you're going to buy above the expansion on your lower time frame, you really want to be ready to cut it if it gets much through that expansion line, because you could be going into a bigger expansion range and there may be a much better entry opportunity down below expansion. So you just need to be ready to make those calls, and you know, you want to adjust your money management according to the opportunity. But just understand that that white line is a decision point. Wherever you enter, you know, if you bought right now, you're below that expansion level right now on the 5 minute. So, you know, you're expecting it to rotate up right now. However, the move has already ran quite a bit. So remember, you know, the more opportunities that go by, you're going to get less and less probability as the trend pays. So, you know, in a situation like this, you wouldn't want to be going heavy right now because it's already made a nice up move. So, you know, keep that in mind too. But just understand, you know, those white lines are giving you the architecture of the decision points. And wherever price is when you want to take a trade, you know, it's either going to go through those lines or it's going to hold, and it's either going to be in your favor or it's not. Just understand that those are the management points, and you just need to treat them accordingly. You know, and structure your money management around what the risk is based off of those lines. So.
Yeah, managing your trade off of these expansion lines is probably going to be about your best bet for managing risk and picking direction. You know, I think that we can all agree. Yeah, I think it's becoming clear that I love expansion line rotations. You know, when you see a reaction and it rolls off of them and then starts pushing one direction, then that to me is like my absolute favorite. It gives me a solid point to manage risk, and it gives a really clear indication of direction, especially if it's in trend with, you know, what's currently going on. One thing that I would like to point out about managing, you know, trades off of these expansion lines is also they'll give you an indication of when to get out if a trade is working in your favor, or at least gives you an you know, lets you know that it's about to at very least go through a breath, at worst completely change direction on you. So right now we're looking at it, it just took out a big liquidity line on the hour, which is kind of lining up with, you know, this cluster of liquidity lines on the 5. We're stalling out. I could see this pushing back up, and now it'll use this liquidity to continue the push up to the long side. But either way, you know, I think we can all agree that we're going through a breath at this point. So I would really be interested to see, you know, how this reacts to this expansion line. If we start getting behavior like this, where it pushes through, rolls off it, and then pushes long, if we get behavior going the opposite direction, that is a really big indication to close your trade out. I think that that's actually represented pretty well in, I believe it's the next pair that we're going to be looking at, which is New Zealand dollar. So let me go ahead and jump over to New Zealand dollar. Give me 1 second.
While you're setting that up, Shane, I want to address a couple of the questions here, or one in particular. Let me see where it was. So from Abdul, when we buy below the expansion line, should I focus on the next liquidity line or expansion line for stop loss level? You can see, you know, the liquidity lines are what they are. They're liquidity in the market, and those give us clues. But the architecture of the market is the expansion levels, and so the most reliable framework you're going to get for forming a stop loss level will be from those previous expansion lines. So, you know, I would definitely recommend focusing in on the expansion levels for your guys' stop losses, and because they do work together. You want to look at the expansion line that you're on right at the moment, but you also want to look at previous expansion levels, because that's going to give you the overall framework and tell you what the real story is. So, it's generally a better rule to follow the expansion levels. And then when you get to liquidity line levels, you're going to ask one of two questions. Are they going to accumulate the liquidity and reverse the market, or are they going to use it to boost the market in your favor? So those are, you want to ask those kinds of questions at the liquidity line levels. But the most important line on that screen for sure is those white lines. So you really want to pay a lot of attention to what's getting rejected, what's holding, and that will, if you wait, if it's unclear, just wait, because you'll eventually get that piece of the story, and then you'll understand, okay, I see what's happening. It's rejecting this level. That means this. It's either in favor for you or it's not. But either way, you need to make the decision. And so you want to base all those decisions off those white lines. That's going to be the best for sure.
Yeah, agreed. And I'm looking through and I see one question from Tony. So Tony says, I'm new and I just want to be clear, you're only buying below expansion, correct? So just to kind of go through this again, and a little bit of the thinking of behind the basic strategy. So in this situation right here, we can see we just broke out of the box. We know that things are still kind of cooking. It's having a hard time getting out above the box. There's a chance that it could. We're not out of the woods yet. We could still reverse back down and get a reaction to this expansion line like we saw on pound New Zealand. So the thinking behind the basic strategy is if you are above expansion on your direction time frame, so in this case it would be the daily, we're above the most recent expansion line, not below over here or any of these back here, but our most recent expansion line, we are above it. So we're looking for long trades. Now on your entry time frame, we want to enter below the most recent expansion line. So the thinking behind it is just by default, you are going to be getting a better trade. What that's will keep you out of trouble on is clicking into a trade right here, clicking into a long trade right here. It's basically impossible to do something like that if you're only entering below expansion. By default, it's going to give you much better entry. And if the trend is actually a trend, it will it won't pull back on you too hard, and you'll get to line up your entry with some of these lines, but like some of these reactions. So this would be a good point right here where we pushed up and started rotating off of this past expansion line, came down, did not take out liquidity, and ended up taking off. So any entry down below expansion is going to be much better off or much better to you than ever entering above. You never want to be on the same side of expansion on both of your time frames if you can help it for your entry. There's rare times where you might get that breakout and it just shoots out of the box and starts pushing, but most of the time it's not going to work out that way. And if that does happen, there's usually a better entry that you just missed leading up to that.
Hey Shane, going along with that, just because I do know we got some new people on the webinar. Those expansion lines, if you've been trading a long time, you guys have probably heard of strategies. They're called mean reversion. It's where you get like a big extension away from, say, a moving average or a Bollinger Band. It's kind of built on those strategies where you buy and sell the outside of the band and trade it back towards the center moving average. It's a mean reversion strategy, very risky strategy, because sometimes they never come back. But so what those expansion levels are, those are the center of gravity of the market. That's value. That's the value price, that's been established on that time frame. So, what they do just naturally, you'll notice that price gravitates to those levels and then gets rejected. It snaps to them and then bounces off of them. So those are the true center of gravity of the market. In essence, what the basic strategy is doing is you're trying to trade against the center of gravity in trend. That's really all it is. So when you're in an uptrend on your directional bias time frame, the reason you're trying to find an entry below those white lines is because there's a really high probability it's going to gravitate back to that line and put you into the money. It's going to get you into the money. And so essentially what you're trying to do is you're trying to define a strong position in trend rather than doing what everyone else does. They wait for the moving average crossover. They wait till it starts pushing and then they jump in and then it just falls back into the range. You guys are trying to buy inside that short-term expansion range and get a strong position and wait for the trend to kick back in. So that's really what it's all about. And then if you're wrong, it's very minimal, to where you'd say forget it. And a lot of these trades, if you practice your entry, you'll get in the money on these trades and they won't even work out, and you'll dump all, you'll take those break even trades. It's going to happen. But because you have such a strong position in the trend, it gives you, you're not going to get shaken out as much as a lagging indicator, would get you in. So, that's what you just want to look at those as those are the value in the market that's been established by how the market makers are doing business, because it's based around, where their portfolio stands, and you're trading against that value in trend and seeing how it reacts. Is the value going to hold, or is it going to get rejected and start moving lower, or higher depending on the trend? So anyway, just want to touch on that.
Yeah, thank you, Wade. I see one other question in here from Mary, just regarding how to use liquidity lines to help you manage your trade. One thing, this will, I'm going to kind of throw in a few little observations. You'll see very often that when you get some weird behavior around liquidity lines, first and foremost, liquidity lines are basically how we use, what we use is profit targets inside of a trending market. So inside of a trending market, it will have a tendency, it being priced, will have a tendency to not take out one side of liquidity and kind of seek out another. So we can see that kind of behavior through here. There was a very easy opportunity for price to break down, take out that liquidity line, but it didn't, and it just kept to the sell liquidity, the red sell liquidity that we see here. As soon as you start getting behavior like this, that is an indication of a little bit of odd behavior. And we can see what happened after that. We did not take that out. We came back down into a range. We did end up taking it out, but it basically turned into a range following this odd behavior, ending with us taking out a buy liquidity line. And we can see that we came almost all the way back to that point. So things are starting to whip back and forth now. There's a normal behavior that you can expect from these liquidity lines. In trend, it will tend to seek them out, and in a range, it will indiscriminately whip back and forth through each one. It's just kind of a rule of thumb to help you kind of manage your trade, and why they're so effective as a profit target, because it'll just keep to one side of the market and keep on pushing through those. Hold on one second. There's a few comment or questions that I wanted to address in here. Give me 1 second just to catch up on.
I got a couple that I was going to touch on while you're looking.
Oh yeah, go for it.
So there was one here. Okay, one thing I want to address, and this is something that I just want to kind of clarify, that I do talk about in previous webinars a long time ago, because one thing that we like to do, because we're in California here, is we like to trade longer time frames, just because of our time zone. So we talk about building a position in the direction of your higher time frame. Say, for instance, you're trading the 1 hour into the daily or weekly. There's a lot of room for exploring an entry opportunity, and we're never going to get it perfectly to the pip. So I talk about building a position, testing an entry that you think, okay, this could be, okay, but it may go against you a little bit, and give you an opportunity to enter, to get a better price. So I talk about averaging in, and what I want to make the clarification from is because I know, as good as anyone that's been trading here, that one of the big sins of trading is averaging losers. So I want to clarify, I'm not talking about averaging a loser. I'm talking about defining an entry range based on the expansion levels that you're working with. Because if you're using a prior expansion level as your ultimate risk point, then there could be 50 pips in between if you're buying under an expansion, but there's one, one below that that's like, say 50 pips away, but the trend is long, you want to get in that trade, but you may not get it perfectly, especially if you're dealing with the higher time frames. So what I'm talking about is averaging in within a defined range where the trade is still valid. So I'm not talking about averaging a loser. Now, if it goes through that specific expansion line, it goes through the parameters that you've laid out of what's acceptable as far as the framework for your trading idea, then you keep averaging in. Now that's averaging a loser. But when you define a range, an entry range, then you can do that and explore, the opportunity for the entry. And like I said, especially on higher time frames, because you're normally not going to get it right. And there may be an opportunity, to get a 30 pip better price, but the trade is still valid. You're not averaging a loser. It's just, you're just exploring the entry. So I just want to clarify what I meant on that in prior webinars.
And just to show an example of that, correct me if I'm wrong, Wade, but what you're getting at is if you're looking at this pair right here, New Zealand dollar on the 4-hour, you're trying to get in on the 15, and you see that this is a potential rotation off of the average price into a long trade, and you get in, you try and get an entry down in here, underneath the most recent expansion, you test out a few entries. It doesn't mean average in. If it whips down below this, keep on placing buy trades. This was your out right here, or this general area down below this expansion. So don't keep on placing buy trades as it just pushes down through here. You have this range where maybe you can try one more entry down in here because it didn't quite take out that low. It's still, you're still flirting with the expansion line, but just kind of kicking back through this overall range if you can get a little bit better discount. But your still ultimate out would be if it doesn't hold above this expansion line.
Yeah, absolutely. That's because you're close to that management point, but that's like what Shane's saying. If you're looking to take that long, which, this market's moved long quite a bit already on that 4-hour. So, let it reset a little bit. But let's just say you do want to go long on that. It may, form a 50 pip range in and around that expansion line on the 4-hour, to where, it's still getting there. And if you just bought on the 15-minute right now, you very well may get a better entry that you'd want to layer in on. But the original trading idea, the out, is based on that expansion level and holding above it. So, that's what we're talking about. You're averaging in on a winning idea. You're not averaging in on a losing idea. And you need to define when that idea will be a loser based on the architecture that the market has given. And so that's what we're talking about. When you're trying to explore that entry opportunity.
Yeah. And I wanted to give a shout out. I should have done this a little while ago, but Baldev, he said that he caught some of the pound New Zealand, pulled 120 pips off of it, traded the 15 into the 4-hour. So just wanted to do a little shout out. That's
Awesome
good
job
stuff.
on that one.
Yeah, that's good stuff right there. So I got a question here from Oliver regarding how we basically choose pairs for the day. And I think I've gone through this a little bit, but I think it's worth going through again. And it's basically how I pick pairs for the volatility report. So for those of you that don't know, I'm the one that goes through and I spend a couple hours on Monday night going through trying to pick out pairs for the volatility report. And most of the time they end up moving. They don't always, unfortunately, go in my directional bias that I set right away, but they usually at least start moving all the time. And just a little bit more context about that directional bias. It's just based on what I see at the time, and there's usually some signs that things are going to be turning, which if you're not sure that you understand at this point, you'll learn over time. So anyways, I'll go through just real quick how I go and choose a pair for the directional, or excuse me, for the volatility report. So it basically starts with me just going to a higher time frame. If you are trading the 4-hour into the 15, then I would recommend just jumping to one time frame higher than your direction time frame is. So that in your case, it would be a daily if you're doing the 15 and the 4 hour. If you're doing like a 5 minute into an hour, then go to the 4 hour and look for things that are fresh out of a box. So if you were trading an hour or a 5 minute into an hour, this would be a good situation right here, because then you can look for something that's starting to move, and you can see the difference in volume, pretty clearly. We had a box right here, price broke out, and now it's starting to really whip around. So you just want to mostly look for things that are fresh out of the box. Something that would not be a good pair to trade, or take that with a grain of salt, but something that you mostly want to avoid is, we had this expansion line back here. This was the second of April, and we've gone all this way, pushed pretty far away from that expansion line. You don't want to start getting interested right here. Pretend we don't see that. You don't want to start getting interested in a pair to trade right here after it's already pushed so far away. We call that overextended. There's a lot of good trade opportunities all through here. You don't want to start deciding to trade something right at the point that it's either going to reverse or go sideways on you. So yeah, that's really basically it. There's a few other clues that you'll probably learn over time, of just looking for things that are better just out of the box. Like if you have a reaction already to work with, like in the case of pound New Zealand, those are a little bit better opportunities. What I mean by that is, here on the daily, we can see it's out of the box, but it may still go down short. It may push up long. There's not a real strong bias, and we're not real close to a decision point either, like we were on pound New Zealand. Pound New Zealand, whichever direction it broke from this expansion line, it was just going to tell you what direction to trade. Whereas in this case, not so much. Hold on one second. Let me go through some of these comments.
I got one here. There's a comment on from John. This is, how do I gauge the expansion whipsaw out of the box? If you're talking about entry, then especially on shorter time frames, you just really want to try to just trade the rotation on the entry is usually the safest point. There's always a trade-off on entry between like quality trade placement and confirmation. Quality trade placement would be ripping the wick, when you get and you try to find that extended point and just get in, whereas that feels scary sometimes. So a lot of people wait for a rotation to start happening, but you're always going to be in the battle between great trade placement and a confirmation on the idea. There's really no way to solve that, but that's if you're trading above and below the expansion lines in trend, like the basic strategy outlines. Even if you get in on the rotation, that should be, if the trading idea is valid, then it should be taken off. But one thing that I do want to talk about is that I'm actually working on a new video we're going to put out on YouTube, and we'll send you guys a link too. But the video talks about basically how to read all the framework put together, and how to see basically the master pattern in the background when reading all of the boxes together. So that video, I've been working on it a while, but I'm going to put that out here pretty soon, and I think that'll clear up a little bit more about how you guys define your entries, and seeing the bigger picture. One thing that I think, especially people that are new on coming to this system, they tend to focus down on the moment, and look at the specifics of the box, and that is important. You do want to look at be in the moment, but you do want to take into consideration the overall architecture of, like, say, the last 3 or 4 boxes. You want to see where it is in the overall range. So I think that this video is definitely going to help you guys kind of define the overall range better and see what the true market condition is, rather than just focusing on the immediate moment. I think it's going to help you guys feel it out. So that should be coming out here probably before the end of the week. Just got to finish editing it and all that good stuff. So anyway, look out for that.
Yeah, I'm looking forward to seeing it. I think it'll be a pretty good video, and it's certainly something that is requested quite a bit. One thing that I wanted to talk about here, just, this is kind of based on some of the emails that we get in, just regarding breakouts. So when price just breaks straight out of the box, I wanted to just talk about that for a second, because I know a lot of people get frustrated when they see stuff like this, when it just, pushes down or pushes long or short just straight out of the box. So two things that I wanted to kind of address with that is, the first one is typically when you see a breakout happen, where it just pushes straight out of the box, doesn't really come back down to test, or it doesn't come back to test the expansion line. Usually in most situations, there was an entry before that happened. So here on the 4 hour, we can see that we had some entries up through here, nice clean rotations off of this expansion line, took out a liquidity line and started pushing down. And then right here, we had kind of a whip up long, and then it just broke away. The second thing that I wanted to address about that is, so just kind of in conclusion of that, if it does break away, it's usually because the entry already happened, and you're just a little bit late to the trade. The second thing about that is that usually if it does break away, it's not the full piece of the story. It did break away from this pretty significantly, but did it really? Because we ended up coming back, and you'll find we ended up coming back to that expansion line right here. And you'll find that all over the place. If it ever seemingly quote unquote breaks away, just has a breakout from a box, it's usually not the full part of the story. So right here, if we continue going long right here, we could see this, oh, it just broke out. But, if you look back through it, we already had an entry leading up into this. So, yeah, I just wanted to make a point about that. Get a lot of questions about these breakouts, and it's a little bit difficult to explain through email. Like we had a breakout right here, but we already had an entry back here where we were down below expansion, rotated off of this, it broke out, and then we can see a little bit later on with more perspective that it wasn't the full part of the story. It just broke away for the moment, but ended up coming back through here, and there's some oddities that happened right here. Hold on one second, man. We have a lot of comments coming in right now, just to let you guys know. So, I apologize if we don't hit everybody, but give
I
me
got
one
one.
second.
Here's a great question from Thomas. Uh, so basically what it is, if you're using like the trading the 5 minute into the 4 hour, and you're trying to look for your entry point on the 5 minute, is it advantageous to say pair the 5 minute to a 1 minute, or maybe the 1 minute to a 15 minute, and narrow it down even further? It can be advantageous, but I'll tell you right now, if you're not used to looking at multiple time frames, that could be information overload. And the 1 minute, if you're not if you're not used to managing that fast of a time frame, it could lead to some serious over trading. So that you got to be real careful. If you've been trading a long time and you really understand, you spent a lot of time with different time frames, then yeah, you can start to see the rotations. You can see that minor architecture on the 1 minute, and pair that to the 5 or the 15, and you can definitely narrow it down. But for if you're just new starting out, just get in on the rotation. Just wait for your entry time frame to rotate, manage your position around the rotation, and trade and trend. Keep it simple. The simpler you keep it, the better off you're going to be.
Yeah, I really agree with that point. Yeah, so often you'll find where it's like, well, I don't have enough lines on this chart, so I'll bring it down to the 5, and then I'll really know what's going on. And it's just so seldom doesn't end up working out that way. Usually things are pretty clear across most time frames all at the same time if there's going to be a real trade. And kicking back between different time frames, it tends to lead to over trading just based on what we've seen, and someone just being kind of, a little term I like to use is gargoyled over their computer, where they're sitting like a gargoyle statue just staring at the candles, without blinking enough. So anyways, I would, just to kind of add on to what Wade was saying, yeah, stick to the time frames that you're used to looking at. Maybe at the beginning of session, flick over to 1UP. So if you look at a 4 hour, maybe just glance at the daily, just to kind of get an idea of what's going on. and be aware of any relevant levels, but try not to harp on it too much and just stick to your screen and make your decisions on that, because you'll be able to find things all over the place that kind of tell you otherwise what to do. So, it's always funny when we see someone who's like trading the 5 into the hour, the 15 into the 4 hour, and like, well, the monthly says this direction, so should I still be trading that direction? It's like, the monthly is important, but not really for a 15-minute trade that you might be in for only a handful of hours at most.
There's a couple of questions coming in regarding the, how many candles confirmation do you need on, to show the rotation? Do you wait for the candle to close? How many candles should be in a pullback? And there is no set number. It's really just about getting a good price. Unfortunately, we have to map the market in some sort of time frame, to give some structure to it. But that's why we're looking at the boxes, because however many candles, it could take 5 candles to create a box, or it could take 15 or 20. It doesn't matter. What matters is there's a box, and there's a high and a low of the box, and then there's going to be the activity coming out of that box. So as much as I'd like to say, we always wait about 5 candles as it pulls out of the box, and then you should get a rotation and wait till the candle closes, and that's perfect. That's just not trading. It's not that's not the reality. And that's where, if you think it's a good price based on the overall range, then that's where you could, you think, okay, I think this is going to work out. I think it's going to be a good price, but I'm not totally sure about it. That's when you go a quarter position in that you would normally trade. You test it, see if that starts working for you. If it does, let that position finance the rest of your risk. It's called pyramiding into a good position. So you guys have to learn, it's not, you don't have to go all in on one price level and hope it works out. Break your position into 3. And if the first one starts working, let that finance your next one. And as it comes back to the expansion line you're working with, then now you're using the profits to fund the trade. But you just have to wait. If you don't have a clear defining point, but you still want to get in the trade, just do it small.
Yeah, that's a really, really good point. And kind of what I was talking about with breakouts before. Usually, if it does break out, it's because there's an entry before, and it's also not the full part of the story quite yet. So I'm sure that, in the coming hours, we'll see something happen here that'll be like, oh, okay, that's why it broke out. So yeah, this isn't the full story right here, but we did have an entry leading up into it.
One thing I wanted to comment on too is that just for you guys that are somewhat new to trading, I'm gonna give you an insider tip here. And believe me, I know we've literally worked with hundreds and hundreds of people over the years. And right to the point where we had a conference table in our last office, and we would sit around, with different people coming in. And just from observing and just my own learning too over so many years, you guys want change is the enemy of traders. Okay. And I know when you're new to trading, you're excited. You want to try different indicators. You want to, you want to be, everyone's looking for the golden strategy. And really, I mean, this is as close to the golden strategy as you're going to get, is price action and something that doesn't change every day. These are hard levels to work with, and that's really the biggest value with ATS, is it doesn't change. So whatever you guys are doing, even if you don't decide you want to use ATS at some point, whatever you're doing, you want to land on something, and you want to stick to those time frames. You want to stick to that way that you approach the market, and you don't want to change. If you're constantly changing your time frames, changing your indicators, changing your settings, you're going to be chasing the market around, trying to fine tune a strategy to that current market. It's the same downfall that people have when they build trading robots. It's called over optimization. You over optimize to a specific set of criteria, and it works real good, but the market cycles change. So you're going to have to learn to roll through the choppy markets, learn to identify them, and wait it out, because eventually, you are going to go into that expansion. That market is going to start trending on that higher time frame, and you're going to be early to the party. But if you're in those situations where your approach isn't working as optimally as you'd like, don't get lost trying to find something else to do and get sidetracked, because just about the time that you work it out and over optimize to some other market or some other conditions is the time where if you just stuck to what you were doing, you would have been early to the party, you would have spotted it, that perfect entry opportunity, and when and that would have added to your overall consistency. So those of you guys that are new, don't change as little as possible. That's really the key.
There was two things that I wanted to touch on kind of with that, Wade. So there was one comment a little while ago from Arturo, and Arturo asked, how do indicators, outside indicators work with ATS? And I was just wondering if you could touch on that question, Wade. Just again, how do outside, I'm assuming other indicators like EMA or Bollinger Bands or anything like that. Do you have any thoughts on that stuff
Sure.
with ATS?
Yeah, so I know it's tempting, especially, you guys that have looked at MACDs and, other oscillators and moving averages, especially, because at the end of the day, it's really just most indicators, not ours, but most of the other ones are just based on some sort of smoothing price average. Um, you can, you don't need any of those indicators. Um, the ATS is a standalone solution. Like I said, the value in ATS for those, especially those of you guys that have been with us a long time, this, the real value is in the consistent framework, the consistent approach, the non-repainting. It is what it is, sensitive price levels to build a trading plan around. It's a map. That's what it is. So the more you add to it, the more you're going to open yourself up to confusion, and the more you're going to open yourself up to that pitfall that I told you is over optimization. You're trying to take something and you're trying to add something to it that's in a, it's going to give you, it's going to just make you feel like, oh, I need to adjust it. Let's say you add a moving average, let's say a 50 period moving average to a 5-minute chart. You know what? And if you're above that, you can literally trade the same thing, as if you're above the moving average, then you're buying below expansion, but above the moving average. You could do that, but what ends up happening is that you could possibly, the day that it doesn't respect the moving average, or it's not, or it's choppy going sideways, then you're going to want to start adjusting that moving average. You're like, oh, you know what? 50 worked good, but I think 100 works even better. And now what you're doing is you're going down that same pitfall. Now you're changing. Best thing to do is stick to the time frames. Use the time frame, your higher time frame as your directional bias, and just use the architecture of the market, and don't open yourself up to that change. But there could be situations where, again, it's like, oh, it's so easy. Why don't I just throw a moving average on there, forget the higher time frame, and I'll just trade the buy below or sell above the expansion line in line with the moving average. Like I said, it could be tempting to do that, and we do have people that do that, but understand that the more you add to it, the more you're going to open yourself up to the possibility of over optimizing, and that's going to waste your time and confuse you at the end of the day. So, what we want you guys to do is we want you to get on the right track as fast as possible. And that means landing on a solution and executing day in and day out without changing.
I might have known that you're going to say something like that when I asked you to explain it. Anyways, Samuel asked a really, really great question, actually. Samuel says, according to what you're saying, and what I was saying at the moment was that, you don't want to trade something that's overextended. But he said, according to what you're saying, that means that on pound dollar, on the 4-hour and the 15-minute, it's overextended and it's ran too far. And I actually 100% agree. So we put pound dollar on the volatility report. That's going to be the last pair that we go through because we were getting pretty close to the end of time. And yeah, pound dollar has, I would 100% agree that it's run too far at this point to be trading it on the 4-hour. You can still test entries always, but at this point it really has run pretty far. So I would 100% agree that it doesn't really make a ton of sense on the 4-hour and the 15, but like the point of the volatility report is just to let you know when things are starting to move. And you know, sometimes it works out and you get a good entry into it and sometimes not, you know, just kind of is what it is. But yeah, just to be clear on, in the case of pound dollar, that on the 15 and 4 hour, there hasn't really been a whole lot to confidently jump in other than through here, which this little whip back and forth was a very confusing or a very frustrating little point to trade, because if you got in through here, it pushed up, ended up coming back down on you, and then, you know, you got a few fake outs through here, so that was a little bit frustrating. I mean, the direction didn't change, and, you know, overall, if you stayed long, you would have been profitable, but this, you know, this would have been a frustrating area to try and get in on. The only clues that I see through here are that we got a reaction to this average price and then pushing down through one after taking out a liquidity line. That's a little bit suspect, but it would have been difficult, or you might have been gun shy by the time the real entry came if you tested each one of these rotations back towards expansion. So anyways, just wanted to make a point about that this was difficult, and don't feel bad if you had a few issues in here.
Hey, there's a great question from Mary here. It says, how about if a box forms on pound USD on the 4 hour? Does that box help reset overextension of the trade? Absolutely. Absolutely it does. Because that's like what we covered last week and what Shane touched on. We talk about those boxes are almost kind of like our, you know, if you think of a stock, it's like our initial public offering. It's like the IPO. It's, you know, that's where the interest is getting into the market. So those, it gives you that new architecture to work with, and definitely resets the market. You know, because you're going to manage your directional bias based on being above or below that new expansion level. So yeah, absolutely. If a market's overextended like that, the pound USD 4 hour is right now, you know, that trade's already happened. I mean, you can still get in if you get a good setup on the 15 or a 5 minute. You know, you definitely aren't trading anything but long, that's for sure. And it very well may go another 200-300 pips. We don't know what it's going to do, but you should have been trading it, you know, days ago when we had the last expansion. Shane, if you could highlight the last expansion on the 4 hour, you're right there. We had it went long. We had 3 red candles right there, and then that first rotation back up again. Right there is you want to be getting aggressive on that opportunity and trading that. And if you have a bunch of money in the bank from trading early on the trend, then you've earned the right to keep trading it. You know, you can milk this trend for as much as it has, but what you don't want to do is that you want to see how many trades have I missed in my directional bias and figure, okay, if I didn't get those trades, you don't want to start going heavy at the top of that wick on the 4 hour like it is now. That's you know, that's what we want to keep you guys early and tight to the line. That's the whole purpose of the volatility report, is finding stuff that's fresh out of the box, that's going to be, you know, we have the proof of volatility coming into the market, it's fresh on the larger time frame. That means that we're going to eventually get some good trending moves on the you know, on the lower time frames from there. So but the whole point is being early. That's really where you want to be aggressive, is around those white lines, and you want to be less and less aggressive the farther you pull away.
Yeah, that whole resetting once you get another box, that is so important. You know, our whole thing is based on these lines. These are our little safety net to make sense of the pushes. So you know, if you don't have any lines to work with, then, you know, you really want to wait for some more to build. And if there aren't any nearby, just wait, because there will be. You know, if you look back, there's lines all over the place, you know, mostly everywhere that you're at. So just, you know, give it a little bit of time if, you know, you miss the trade. And one thing, just to not confuse anyone, Wade was talking about on pound dollar. I'll jump back over to New Zealand here in a second. Wade was talking about pound dollar for the point of, you know, for making the point that it has had a lot of movement up, but at that, a lot of that was inside of the box on the daily. Of course, if you're trading a 4 hour, it could be, if you're trading the 15 into the 4 hour, it could be debatable whether you want to trade that or not. But, you know, as far as the daily goes, it was in the box, but just kind of for the point of illustration, you don't want to start jumping in at the very tail end in most situations. So, you know, ideally on the 4 hour and 15 on pound dollar, you want to wait for a little bit more architecture to build and then go from there. So getting a lot of comments just about what's going
There was
on.
a comment from a while back, I think it was from Mary, about, I just want to address, um, about trading a higher time frame, like say the 1 hour. Is it still the best to look for your entry opportunities in the London, New York session? That is typically where you're going to get, the best entry. And 1 hour is kind of on the border of where you'd want to keep to those time frames. So yeah, the answer to that question is, you definitely want to be aware of your trades and what's, even if you're building a position, you want to see kind of where the session, peaks, where the peaks and valleys are of the session to look for your entry opportunities. Because typically during the Asian markets, at least on the major pairs like Euro USD, Pound USD, usually goes pretty flat. And then you typically get an expansion out of that low volume. You'll get probably box, and things like that. But the real best entries are on those tips of the wicks and on the rotations that happen in the session. So yeah, definitely, that's for an hour. The smaller the time frame gets, the more you want to be in that area or that volume range of those sessions. But if you start entering, say, on the 4 hour into the weekly, or the daily into the monthly, it's not gonna matter quite as much, because now you're just basically looking at the direction of the days. Are the days gonna close up? Are they gonna close down? So that's gonna get less and less important. But the hours it's kind of on the border, of, just find decent trade placement. But finding an entry in session or out of session could be the difference of a 50 pip better price. So, that's something you definitely want to take into consideration.
Yeah, I agree. Wade's the master. He's the master of all the stuff. Well,
Thank
I
you.
wanted to address
Very
one thing.
kind of you.
Um, I just wanted to address a few things about the actual entries. So, we get caught up in talking about theory on stuff like this. So I wanted to kind of go through New Zealand dollar and talk about some of, what's been going on right here. So we broke out of this box on the 9th. So that was the first candle out. So I'm going to go ahead and flip over to the 4 hour and the 15-minute, and we can talk about what's there. So the 9th would be, yeah, it was a little while ago. So it would have been after this push right here, and then we took out a liquidity line and started kicking back and forth and went into a box pretty quickly. So if you're watching the 4 hour into the 15, how would you be handling this right now? So this kind of goes back to what I was talking about with breakouts, where if it breaks out, it's usually because you don't have the full piece of the story. So broke out, but we can see we're starting to come back down and test this expansion line. As far as actual entries go, you would have wanted to stay long through this, and kind of the best entry that I see through here. So we broke out or broke long through here just in this little session that we've got since we broke out of the 4 hour box. This would have been a good entry right here. This was not above, or this was above the most recent expansion line, so you would not have been looking for an entry right here. But then we got a new expansion line and broke down, price whipped down short, and we had a reaction to a previous expansion line. So when you see that and it starts reacting off of it, then you can get in once you see the turn on some of these and manage your risk off of that expansion line. So that would have been the first entry into this, and we can see that it worked out pretty well. We came up, took out the liquidity line that we had, whipped back, formed another box. You could have closed if you wanted, but if you didn't, then you got a pretty nice little profit out of it.
Yeah, that's
Something
really,
to,
I would say that's really ideal, Shane, that one that you're looking at. When you get that reaction off the previous expansion level, that's showing that that's giving you a clue that the trend is still intact. That's a clue. If you're trading long, you're looking for clues to reinforce the higher time frame on the lower time frame. And that right there, if it's rejecting going short through a previous expansion level, well, what does that mean for the overall trend? It's good news, right? So if you rip a long trade on that rotation on the 15. Shane, if you could go back and highlight that candle uh, right there, or you just wait till you get that first green candle right there, where you got to ask, okay, that was the clue, is getting the rejection off of that expansion level. You're starting to see the resulting rotation, the 4 hours still long. Where would you manage your risk from on that? Right there. Because if you're wrong on that trade, it's not going to go, if it gets below that piece of architecture, it's probably turning the 4 hour at that point. So that's a low risk, uh, good opportunity right there. And that's, there's nobody's forcing you guys to get in a trade. So if you just wait for that situation to happen, and it happens a lot, uh, that's a good entry point right there. And that's going back to the original question of, how do I navigate the expansion range and try to find, how do I find the rotation? Well, that's how you navigate it right there. You look at the previous framework, and when you get those reactions, when it becomes clear is when you take action. If it's unclear, let it go. There's always, I remember the first guy that taught me about trading. One of the first thing I was looking at his screen, and he's like, look at that move, that move, and I'm like, oh man, look at that, and look at that. It's like you want to trade everything, but one thing he told me is like, there's always another trade. Never get upset about missing something. There's always another trade coming. So wait till the situation comes up and you have a definitive clue that's in your favor that causes you to take action, and you can manage your risk off of that level. And if it's not great, then you could still trade it, but don't trade it as heavy as you normally would. You want to save your biggest positions for the tightest risk, and if you don't have that, just be a little bit lighter on the trigger. So, good question just came up from Edward. Just we'll address it. Is ATS going to come to MetaTrader 5 soon? The answer to that is yes. We have been working for a while on a new update with a new licensing structure. It's going to get rid of the license keys as they are now. Basically, you just load the files, and I think they will have one license key up front, but the way that we're getting it done, but you'll basically just load the files, and then there won't be any more of that stuff. Um, uh, One thing that we're going to do is that we're going to finish it for MetaTrader 4. But once we have everything done for MetaTrader 4, it's not going to be that big of a deal to recode it for MetaTrader 5. So that will be coming probably pretty quick after that. And as of right now, this whole coronavirus pandemic thing has really kind of put a damper on a lot of stuff. It's not we're still moving forward, but it just definitely slowed things down a little bit. But we should. I'm hoping that we should have those updates for you guys. Or we should have something for you within the next like 3 weeks or so, I would say. It may be quicker than that. We're on our coders every day, trying to figure out what the deal is. And we lost one of our main coders due to some other stuff that happened. And that kind of, we had to regroup and hire some new people because of that. So that slowed things down. But anyway, we should have stuff coming out. I'm hoping within the next like 3 weeks or so, or at least we'll have within that time, we should have a specific date that we could shoot for. But we'll let you guys know that. And then, like I said, right after, we're going to do it for MetaTrader 4 just to get it out there. But then right after that, we should be able to do it for MetaTrader 5. And then after that, we're looking at other platforms like TradingView and things like that too. So anyway, we got a lot of good stuff in store for this year. It's gonna be an exciting year. We got a lot of cool stuff coming out.
Yeah, so stay tuned for all that. Real quick, so going back to this, I wanted to talk a little bit more about, what took place here. And again, the stuff that I'm talking about, it applies to every time frame. It just happens to be that we're on the 4 hour and 15, but this behavior of reacting to the price levels and this type of entry, it's all the same regardless of the time frame you're looking at. So kind of back to what we were saying, this would have been, kind of your ideal entry into this trade, manage risk off of that, get in somewhere once you think a turn is happening, and the manage risk right off of, either the low of the previous candle or just this general expansion line. and you know that you're long because you're above the most recent expansion line, you're outside of the box, so you're looking for a long trade. One thing that I think is really important to bring up is this right here. So we had a breakout, and if you're in that, all you know is that you're really happy at that moment, but then we form a new box. When you see something like this, if your directional bias is short, this is an ideal entry right here into a short trade. If you're sitting in a long trade and you see an ideal entry into a short position, that is a really, really strong clue to dump that trade, that something is about to happen when you see something along the lines of this. And we can see very shortly afterwards, it plummeted. And also kind of going back to what I was talking about with breakouts, that you don't have the full story, but just ignoring that, we had a very strong clue of something about to happen right there. So price ended up pushing down. I don't know that you would have really wanted to trade this because we are still above our most recent expansion line. Price broke down, and I'm just really hoping that none of you would have traded this because it's whipping back and forth around the expansion. Maybe still test an entry, managing risk off of it, but we know that it's going to start whipping back and forth around expansion. Give it a little bit of time to maybe react to it, and then try taking another long trade. So the only real one that I see in here is we pushed down through these liquidity lines and then came back up. Once it started reversing, maybe entering a trade on this turn right here and testing, and managing risk off of, the general expansion line right here on the 4-hour chart into a long trade. But that was a little bit far-fetched. I mean, it was a bit confusing, because we had that, but simultaneously we were rotating off of some of these lines or off of these expansion lines. This was a confusing point, which is, pretty standard for it to get a bit confusing around these, because we know that it'll start whipping back and forth at the expansion. So yeah, anyways, this was confusing. We see that we had a breakout. It looks like it's reversing, just kind of, back to what I was saying before, that breakouts are never the full part of the story. So we'll see. I'd expect that it's probably just going to kick back and forth around this expansion line, probably for the rest of the session, and maybe later on this evening, or in maybe 9-10 hours, we'll see a clear reaction and then really start pushing away from it.
So it's a good question from Pablo, to basically establish a take profit point. What we're generally looking for is we're looking for some sort of liquidity line or something. What you really want to do is you want to ask yourself, where does my higher time frame, what's reasonable for it, where could it push? So you could ask yourself questions like that. But also too, if you have a liquidity line, on your lower time frame, you can see, okay, I'm in profit now. I just hit this liquidity line. Now I'm going to see, do I get a strong reaction from it? What happens? Do I just blow right through it? If you blow right through it, then that could be definitely a clue to stay in, because they're just totally disrespected the liquidity line level. That means they're just using it to push the market. So, it's going to be different for every trade, but the general rule of thumb is that you want to sell into strength and you want to buy into weakness. So if you're going short, if you get a big aggressive push, everyone's going to see that. They're going to jump in on that, and you want to be selling to them. Essentially, you want to sell to the people that are falling victim to FOMO. So just think about it that way. If you do get that aggressive snap, but there's no liquidity line, there's nothing, there, you want to think about, okay, the cat's out of the bag now. So, what you just got to make those choices. That's always a difficult thing, is how to close a profitable trade. But that's just a general rule of thumb: sell into strength, buy into weakness, whether you're going long or short, and be happy with it. And if you have some architecture to work with in that moment, then use that. But that's the basics. Is you get a strong push, the cat's out of the bag. You want to take your profits off the table typically.
Yeah, and I also want to follow up on just how to manage your stop. So we'll look at this little situation right here, just because I think this would be pretty challenging for most people to navigate, because you're right around a decision point. You know, you're anxious to test an entry to see if you're going to be in the next big push. So, you know, how do you manage your stop in here? Well, if you decided that you wanted to test and see if it was going to whip back and forth and push down to the short side, then you would be managing your risk off of any of these expansion lines. You would be trying to enter above expansion and then manage your risk off of that expansion line. So again, there's no real right or wrong answer in this level because we are still so close to expansion. You know, that's why it's so important just to test entries with real low risk. Once we start breaking away and we can see that this was a clean rotation, if it ends up being that, then you know you want to be a little bit more biased to, or you definitely want to be more biased to the long side. But you know,
What
realistically, I know that it doesn't always work out that way. Sorry, William.
one thing you want to think about if you're looking to go long on that, and this is not, I know we're like focusing in on this specific opportunity. Keep in mind that 4 hours ran up quite a bit. Okay. So don't get too hasty here. But um, what let's just, for the example, if you're looking to buy off that rotation here, you got to start asking yourself. It's usually just a series of questions. You got to ask yourself, okay, I want to go long here. I feel like the 4 hours is going to go long. It starts with that. How great do you feel about your higher time frame? So if you feel great about it, you say, I want to go long here. What has to happen on that lower time frame in order for that to work out? Well, it's going to have to eventually leave those three boxes behind. And if it does breathe back, it's gonna need to respect those lines, those white lines. So, that's really you gotta that's the basic thing. If the trading idea is gonna work out, these lines will be respected. If you enter a trade and those lines are not respected, now we need to question the trading idea. So it's usually a process of elimination, and it's constantly asking yourself, you know, if this is my idea, what needs to happen according to the architecture that the market has given in order for that idea to be valid? And we don't know how long it's going to take. We don't know the exact amount of bars, but we do have the sensitive price levels. So what needs to take place generally for this to work out? So as long as you keep asking yourself those questions as the idea forms, as you enter the trade, then you'll be kind of forward thinking through the whole thing.
Yeah, that's really important. Just basing it. I know that we're going, or I'm going a little bit deep on this, even though it's not that great of a market. But you don't know that it's a great market or a bad market right up until you kind of got beat up a little bit through it. So I'm trying to be a little bit more realistic about what some of you guys might run into, because up until this point, it's like, wow, this thing's swinging back and forth. There's some good movement coming up through here, and then it ends up just going into a box. Keep in mind it is well, at least in our time, it's 11:24 a.m., which we know that the market is not going to really be moving through here. But regardless, you want to base your trade off of one of these lines and form a theory about it or a premise. If your premise it's going to go short, then you would base it off of it rotating off of some of these expansion lines and then manage your risk off of those same points. Because if it goes through them, then your premise is no longer accurate, that it's not rotating off them because it just went through. So, you build a trading idea about, through these lines and the reactions to them, and then you manage your risk off of those levels. So just to kind of give a little bit more to that, there was one question that I wanted to hit in here. Give me 1 second. So here's a good question. When is it too far away from the expansion line on the higher time frame to really reference, or to I guess I'm just going to add on to that to know when something's overextended. If you can look back through at a trade, so I know that a good chunk of this was in a box, but just for the sake uh, of explaining this, if you can look back through something and see that it is very clearly already pushed, whatever that may be, just hold off from trading it. It's like, oh, it's a strong downtrend. you know, right here, oh, it's in a strong downtrend, that usually means that you're too late to the party. You want to be a little bit, you know, if you're still a little bit confused about what the overall direction is because it's just starting to take off, that's a good place to be. And then there's, you know, there's the best entries and then not as good entries. You really just want to stay away from jumping in at the very tail end after it's already had a big push or something like that. Again, I get a little upset when I see, you know, entries right around this level at the final, you know, after a big snap. Let me go back through. I think we'll probably be taking just one or two more questions, and then we'll probably be wrapping up. We've been going about an hour and 30 minutes now.
So here's a good question. Talking about getting out of a trade at a certain time. Uh, so kind of if you're trading within the London, New York session, and let's say you take an opportunity, uh, the way you guys could do whatever you want, but kind of the way I think about it is, look, if the opportunity has put me into the money, let's say you're in a long market on the 4 hour and you find a good entry on the 5 minute, and you buy, you know, below expansion, and now it puts you up into the money. But guess what? Now it's like, well, we'll say it's like noon our time here in California. That means, you know, the volume's pretty much wrapping up for the day. You know, if I'm up 30, 40, 50 pips, you know, I've earned the right to sit through the Asian Open and see if that trend doesn't kick in. If you're in a trade and you're coming into the end of the session, you know, and you're like, you know, up 5 pips, down 5 pips, it's just not really taking off. It's usually better, you know, just to say forget it, you know, be it break even. Don't take the risk of, you know, having a big reversal coming into the next session. You know, so let your profits earn you the right to make those calls. If you're not heavily in the money on a trade, you know, or up, you know, sometimes you guys will hook huge winners on the lower time frame. You'll be up 50, 100 pips, and you caught the beginning of a huge trend on the higher time frame. You know, at that point, you've earned the right, even if it defines a new expansion range on the lower time frame. It's probably, you know, not going to come down and blow you out because it's pushed enough. So, you know, let that be the determining factor. But don't get, you know, like I said, if you're at break even or it's not really taking off and you're coming into the close of New York, you know, it's sometimes it's better just to stay at cash and wait to see what happens the next day.
Yeah, and then sorry, I wanted to follow up. We have one quick question from Cynthia just about managing profit on some of these trades. You know, do you use the liquidity line? What do you do if you don't have any liquidity lines, or, you know, just managing profit in general? So I just wanted to speak to that for a second. So looking at pound dollar on the 4 hour and the 15 minute, we can see that we actually don't really have a whole lot of lines to go off of right here, which makes things a little bit difficult. I'm not going to lie. It's a little bit more difficult to kind of be able to look at where things could potentially push. In the case, some of the signs that you would want to close a trade out, you'll very rarely get it where the tip of a wick closes out on a liquidity line and then it just turns and everything plays out perfectly and you get every single pip out of a run. You know, we just have to mostly get the entry right and mostly get the exit right, is, you know, what you can realistically expect.
You're just trying to get some out of the middle. No one's trying to call the tops and the bottoms. We're trying to define a trade that's already in progress on the higher time frame. We're trying to spot a decent low risk entry, and we're trying to get something out of the middle. That's it. And we're going to use just general principles, like I said, sell into strength, buy into weakness, or if you have architecture, liquidity lines to work with, you know, ask yourself questions when you get to those levels. You know, what needs to happen here for me to keep going in the money? And if that doesn't happen, then, you know, close the trade. So that's, but yeah, we're not trying to get it perfect. We're just trying to get some out of the middle. That's it.
Yeah, exactly. Just trying to get, you know, as much as you can out of it. But I would say, so in lieu of not having liquidity lines, those are ideally what you want to use as your profit. Now, remember that when you're looking at these liquidity lines, I kind of spoke to it earlier, you're looking for a behavior of price not taking out one side and you're expecting it to keep on pushing up through liquidity lines. So one way that you can close your profit if you want to take out maximum. And this is assuming that you are in a good trade and you're looking to take profit. You know, you're using them as your profit levels. One, you can get out on pretty much any liquidity line that you feel, you know, if you don't think that it's going to keep on going, then you can get out on when it takes out a liquidity line. A behavior that you can use to help you maybe, you know, potentially get out with a little bit more profit is looking for the behavior of turning off of a expansion line the opposite direction. So this would be very similar to what we saw on New Zealand dollar after we had that snap up and then we had the rotation off of the 15-minute expansion line before it went short. That breakout that we had, looking for behavior like that that would suggest the other direction. You can use that to get out of a profitable trade. Or if you want to make the decision, you can get out when you take out a liquidity line of the opposite color. So that one can be a little bit rough because sometimes it's really far away, and if you wait that long, it can cut into your profits quite a bit. So you might want to, you know, do your best to focus on the other ones first, because at least you'll be on the other side of a potential range. So it's just kind of those, and you know, and also looking for similar things on the larger time frames. You know, you'll see things starting to build up. Liquidity lines usually are the best profit points, but yeah, just looking for some of those behaviors, you know, like say you were able, you know, just hypothetically, you were able to get into this trade here. If you saw the price came up to this past expansion line and was starting to kick back and forth on it, and you didn't know if it was going to turn, that would be a very reasonable time to close out your trade, because, you know, you're just not sure. You can make the call right then if you're up in profit and you want to see, you know, want to keep on riding it. If you want to, you know, wait and see if it's going to breathe off of it and then continue pushing, which it ended up doing, but that would be another reasonable place to get out. Mary's asking me to show the example that I was mentioning on New Zealand dollar. 1 second. So I refer to the behavior this right here. So you're in a long trade, you know, technically we've still taken out, well, we actually take out a liquidity line right here, but if, you know, for whatever reason you waited through that and you saw this behavior, what would be a perfect entry into a short trade? You know, that could be another good indication to get out as well. Anyways, I think, yeah, Wade, do you have anything that you want to follow up with? We're starting to get pretty long-winded here.
I think we're about done. As much as I love hanging out with you guys, we are getting pretty late here and we got to get into some other stuff. So anyway, hopefully you guys got some good tips. And like I said, this is, you know, we're trying to get you guys, those of you guys that have been with us for a long time, you know, it's the same stuff over and over again. There's nothing new here. But for those of you guys that get started, you know, it's all about keeping it simple and trading in trend. The only way that at the end of the day that we can have any consistency as traders is the fact that the markets trend. So, you know, if it wasn't for that fact, you know, then it would be very hard to do anything in this business. So stick with the trend, practice the entries. And for you guys that are new, go back and watch the, you know, the other archive webinars. Because, you know, if you have questions or something that we weren't able to get to right now, chances are it's been addressed probably several times in those old webinars. So, you know, in your spare time, I definitely recommend going through those as well. So anyway, that's pretty much it for today. Thank you guys so much for being on. And we will plan on seeing you guys Tuesday of next week for that webinar. In the meantime, everybody stay safe and we'll catch up with you soon.
Thank you all.
Bye-bye.